Let's get back to the markets, and we're going to talk technicals with Katie Stockton, Fairlead Strategies founder, managing partner, and a CNBC contributor. I just noted Halima was just on. She goes, "Oh, we're going to talk fundamentals." So now I just want to say we are not going to talk fundamentals.
No, I think we'll stick
so
to
no worry about that at this point. I'm trying to figure out whether we are in a 50% retracement of the recent pullback, or are we in a 50% retracement of the even bigger rally that we saw? Are we in, or neither?
Well, I think it's a pretty orderly pullback to this point, but it has damaged some of the intermediate term gauges. So one of our risk metrics is the 20-day moving average. It's rolled over already for the major indices, and that's an indication usually of a significant enough of a loss of momentum to suggest it's more than just a brief pullback. So we've had the pullback. What we're looking for is a rebound this week, maybe next week.
But like a relief rally rebound, not
something to sell into if you're
last
managing risk short term. Because we think the corrective phase could last kind of seasonally into the early summer months. And we say that because of that loss of momentum, we also have finally a reaction to intermediate term overbought territory. And that's something that tends to see several weeks of corrective action.
And finally, a reaction to some of the fundamentals that you don't talk about in terms of interest rate paths and the 10-year and because you don't need to talk fundamentals on what's causing it, but what about the 10-year? What are you seeing there? What should we be expecting? Or inflation?
Yeah, it did clear a resistance level of about 455, and that gives it room to 5%, sort of unfortunately. But we are looking for a lower high versus 5%, and that's because of a loss of long-term upside momentum behind yields. And that should be conducive, of course, to resumption higher maybe after a corrective phase. So we think yields are going to be a near-term challenge, perhaps, still for the market. Maybe not next couple of weeks, but beyond that.
Katie, it's kind of hard to divorce the fundamentals from the technicals in this aspect, though. We've got the CPE coming out on Friday, and I would imagine that's going to reset the bar for one direction or the other.
Well, it can serve as a catalyst, certainly, for any kind of volatility, right? Upside and downside. We think it's more likely to the upside based on what we're seeing in terms of the short-term oversold readings.
Upside of yields, or?
Upside for equities,
okay.
Right? So a rebound higher for equities, something that folks can use to sell stocks that have either broken down or have that same loss of upside momentum that we're seeing on a pretty broad basis in here. So it is a meaningful pullback. And listen, it follows what was a really major and prolonged uptrend. So we feel like it will ultimately prove to be very healthy, yield a nice buying opportunity for us during the summer months, and something to take advantage of what we think will be a strong finish to the year.
Live by the sword, die by the sword. I mean, Apple, Tesla, NVIDIA.
Those two are tough.
There's a lot of the former darlings are some of the biggest losers. I guess it's not unusual, but it's not helpful, is it?
Well, we do need to contextualize for the previous winners like NVIDIA or Meta, Amazon, which just fell below its 50-day. Those have exhibited such strong upside leadership, have strong long-term upside momentum, and I don't think that's going to change. But Apple and Tesla are different beasts. I mean, Apple has taken out the support that we've been watching around 169 to 170. If that breakdown is confirmed this week, that's a significant decline or sort of setback for Apple. You've heard of a double top formation. It basically looks like an M. That's Apple for you if it confirms this breakdown. And Tesla's a downtrend, so it's a downtrend, and it's sort of respecting just lower highs, lower lows, and staying true to that for now. So it's obviously out of favor and really isn't part of the mega cap complex at this time.
How about gold? A very famous analyst I follow, William Devane. I don't know if you know him.
I don't know him.
Okay. No, he's an actor. But he sells a lot of gold on another channel. But he puts all his money in gold because he's worried about debt. But what about gold? 3,000?
I wouldn't put all my money in gold.
3,000?
It has been acting really well. We actually can arrive at targets that are pretty impressive, 2,800 plus for the price of gold. And yet we're looking for near-term consolidation. We've had a major breakout from a long-term range.
Yeah.
But it's part of a commodity bull cycle. I mean, we're seeing strength from other commodities. Look at copper. No one's talking about copper. Wow, that's quite a run. But we are looking for consolidation there, too, near term. And by near term, I mean days to weeks, not weeks to months.
Yeah, I'm not going to ask about Bitcoin. I just don't feel it. I just don't feel like
it.
I just don't
Pass.
feel
You don't feel like
I don't know. I don't have it in me. I don't want to get you started. I don't want to get you started, number one.
They look just like equities. So short-term
Yep.
oversold bounce to give way to a more significant corrective phase. And again, we should welcome that as an opportunity to take advantage of what was a very long-term breakout.
Yep.
We should tie to equities. You think it's like just
the correlations are sort of coming
Definitely
back.
a risk-on speculative asset, which makes it a little different than gold. I don't think of gold as risk-on speculative.
Yeah,
anymore.
and it's not necessarily overtly risk-off at times. So.
Yeah.